Hey everyone, as Tesla's stock price keeps crashing, investors are becoming more and more concerned about the viability about the company's longer term prospects. Now, I've been one of the more negative investors on Tesla stock, telling investors to avoid Tesla in 2024. That being said, I wanted to put this drawdown in its stock price into perspective. I wanted to share with you Tesla's balance sheet and really cover how strong of a position Tesla is in overall in terms of its viability, its survivability. While the near term, it's under pressure in terms of sales and growth in all of those forecasts. Longer term, the company's capability to survive is unquestionably stronger than nearly all of these other EV companies. So I want to share with you its balance sheet just to kind of reassure some of those investors that might be getting concerned about Tesla's survivability.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So like I mentioned, Tesla's stock price has been under strong pressure, down 2.74% again today, and year to date Tesla's stock price is down 37% as of this recording, a big drawdown for one of the most popular companies in the market today. So let's look at the balance sheet so that we can get some reassurance that these are just near-term troubles for Tesla. Tesla's at no risk, I could say, of going out of business. Its balance sheet is very strong, nearly the strongest of all the auto companies that I follow. So let's take a look at its balance sheet in terms of assets and liabilities. Starting with what I have highlighted here, its cash balance. Tesla has $29 billion of cash on hand, cash and equivalents, as of December 31st, 2023. $29 billion. And at current interest rates, which are roughly around 5%, that means Tesla can generate around 150 million in profits by investing this cash into super safe government bonds. So that's $150 million it can just generate in profitability just from investing this cash balance. That gives it a nice boost in terms of generating profits while the rest of its business struggles amid falling EV demand and rising competition, leading to price cutting, price wars, and rising wage pressure as well. So that's a nice cushion there for Tesla. The next thing to look at is inventory. And as of December 31st, Tesla had $13.6 billion worth of inventory. That was actually down from its peak level of 14.375 billion. So while its sales have been under pressure, it's balanced that with slower production. So it hasn't been building up or accumulating inventory, which can be a concern, especially for car companies like Tesla, because the older these cars get, the more you have to discount in order to sell, because consumers looking at a 2020 model are not going to want to pay as much when there's 2024 models, 2025 models out there. So you don't want to let accumulated inventory build if you're an automaker like Tesla. So that's been good. Although I will note that in the latest quarter, Tesla, when it announced its production and delivery numbers, had the biggest difference between production and delivery, indicating that inventory has built up more so than ever before. You could see it said it produced 433,000 vehicles and delivered only 386,000. Now, while there's always a gap between production and delivery, because some of these produced vehicles are in transit on their way to customers, this was the biggest gap that I've seen since following Tesla for several years now. So that's likely led to an increase in inventory balances for Tesla. I'll be paying close attention to that when the company reports earnings. Now, another thing I've highlighted here is Tesla's property, plant, and equipment balance. Now, this is net, meaning it's taken off depreciation already. So it doesn't account for all of the money that Tesla has put into its property, its manufacturing plants and equipment. It's subtracted by the accumulated depreciation in these assets. Still, this balance is rising 29.725 billion. That's up from 23.5 billion in the same time the prior year. So a roughly 25% increase in its long-term assets or fixed capital. In other words, investors, when they see a company adding fixed assets, they demand or they require or they look for the same company to increase its profitability. It's not unlike if you're operating one restaurant, your investors will expect a certain amount of profits from you. And if you add a second restaurant, they'll want to see more profits. That makes sense, right? Similar with Tesla. If they see you have a certain number of manufacturing capability, they'll require a certain amount of returns on that investment. And if you're adding manufacturing capacity, if you're adding fixed assets, investors will want to see a greater degree of results. And it's been the opposite for Tesla. As the company has added billions of dollars of fixed asset, its profitability is coming under pressure. And that might be one reason or another reason why Tesla announced the 10% job cuts yesterday to kind of boost profitability, because it's noticing that demand is not strong and demand is not going to rebound anytime soon. With interest rates rising, most people finance their vehicles, and the higher interest rates are going to make them less likely to purchase. And so the job cutting will help Tesla generate greater profitability amid slowing growth. Also, looking at the debt side of the equation, Tesla does not have troubling debt. It has roughly 43 billion in total liabilities compared to 106 billion in total assets. And again, the bulk of its total assets are in short-term assets that it's going to turn into cash. So 29 billion in cash, 13 billion in inventory, and 3.5 billion in accounts receivable. So that's about 46 billion dollars in cash-like assets, whereas its debt, its total liabilities are less than that, only 43 billion, and very small portion of that is in terms of interest-bearing debt. So it has some 2.8 billion in finance leases. It has 8.1 billion in other long-term liabilities. So roughly 10 billion of its total liabilities are generating an interest expense. And if Tesla wanted to, if these debt balances become too burdensome in terms of the interest rate, it can use its cash and just pay off all of its debt if it wanted to, right? But it's generally not advised for companies to pay off all of their debt and have zero debt, because the cost of debt is usually lower than the cost of equity. And a company has a weighted average cost of capital mixed with how much debt they have and how much equity they finance the business with. If you finance your business with all equity, then your cost of capital is higher, which brings down your valuation. Whereas if you have more debt, then the cost of capital, the weighted average cost of capital, is typically lowered because debt comes at a lower cost than equity. And then also, when you're paying an interest expense, the interest expense is tax deductible in the US at least, so that brings down the cost even more. And so it's opportunistic for companies that are in good shape like Tesla to have some debt, even though they don't need it, but it's still opportunistic to have it because it brings down the cost to finance the business. And so it's advisable that they keep on some of this debt and not pay it back. So I hope this analysis of Tesla's balance sheet highlights just how strong of a position it's in with all of that cash, nearly 45 billion in cash-like assets, and debt that's significantly lower than that. It's in no danger in terms of that position. Now, it's not growing as investors would like to see Tesla grow, and its demand is not going to be strong for at least the rest of this year, perhaps even the rest of next year, but it's in no danger of going out of business or in no danger of any financial distress. It's just not going to grow at the rate that investors expect it to grow to compensate them for the expensive price they're paying for Tesla stock. That's the difficulty with Tesla. It's not that it's in bad shape or that it's going to go out of business or it's not going to survive. None of those things. The difficulty with Tesla that I keep griping about is that its growth in profits and cash flow don't match up with its expensive valuation. You're still paying an expensive price for Tesla stock, even though it's down so much. But all that being said, the company, excellent balance sheet, way more cash than debt, and so it's going to survive. It's not in any danger of going out of business. Even if its stock price falls another 50%, the balance sheet remains the same. It doesn't impact the balance sheet for Tesla stock investors. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.